It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast. Yes, your daily breakdown of the Australian property market. Independent property insights without any sales agenda. Yes, we're not trying to sell you anything. Instead, you just get weekly looks into what is happening across the real estate sector. And if you are new to the podcast and would like to get involved, we would love to hear your perspective. Plenty to talk about. And there is a voice message link in the show notes. Simple to use, and it puts you alongside hundreds of others sharing how they see the property market unfolding. Or, of course, you can use the trusty email. That is myrealestatepodcast@gmail.com. Well, it's a Tuesday. Nice to get Monday out of the way, chasing our tails as it always goes for a Monday. May the 12th. Some good news ahead of tonight's budget. The government is bringing in AI to cut through the red tape holding up new housing. Now, we're talking over $100 million to speed up environmental approvals, which has been a massive bottleneck for years. The Treasurer is betting that smarter tech means more homes and more homes faster. That's not bad. And it's a bold move to fix supply, but with changes to negative gearing also on the table tonight. The landscape for investors is definitely shifting. Let's go to Sydney and catch up with Veronica Morgan from Good Deeds this morning. And good morning, Veronica. Last week I talked about how over the past 12 months, many borrowers stayed on variable rates, hoping interest rates would ease sooner rather than later. Instead, repeated rate rises have placed more pressure on household budgets, and some people are now questioning whether they have missed the ideal opportunity to secure certainty with a fixed loan. So this morning, I just want to throw this up to you. Looking back, do you think was last year the missed window for borrowers to lock in that fixed mortgage rate?
Well, I think we always make better decisions in hindsight than we do in the present, don't we? Now we have the benefit of all the information and all the things that have happened that have surprised us, and we now know that inflation was sort of rising anyway. So I guess towards the very end of last year, there were some signs, and there was talk change from further interest rate reductions to increases. Simple fact is, yes, if you didn't fix last year, you probably did miss the window. I think we need to get used to a bit more of a volatile environment at the moment.
Yeah, because I said last week that, yeah, sure, there's certainly everybody's chasing the best possible deal. There can be that greed factor, but, you know, a lot of people are on the margins, on that thin margin where you get these increases in the rate, and then it makes it very, very difficult to get that mortgage payment made. So you've always really got to be looking at that insurance factor.
I'm risk averse, so I know what I do personally, but a lot of people would rather sort of chasing cheaper rates. But everyone has their own individual approach, I guess. Even when you're talking to mortgage experts, nobody puts their money on the line, really, if you're taking their predictions. So I think we always need to be careful when we're making decisions around fixing or keeping variable. We have to be careful that we can actually afford a few interest rate rises at any time that we make these decisions.
Yeah, always got to stress test yourself. Forget what anybody else is doing on you. You know your situation better than anyone. Now, because we've got the budget coming up later on tonight, Sydney investors are now operating in a market where borrowing costs are higher, growth has slowed, and holding costs continue to rise. Some of these investors are becoming more selective, while others are focusing heavily on rental yields, cash flow and long-term positioning rather than short-term capital growth. From your end of the market, Veronica, in Sydney, what are the Sydney property investors actually doing right now in this current market of conditions?
Sydney's not been booming, really, even though we've copped a hit in the last few months. Sydney hasn't been booming in the last few years. We've had a very flat market for 2 years in terms of price growth. Rents have been increasing, so the actual yield has sit pretty flat at 3% for the last couple of years. So I don't think anybody's been really looking at the Sydney market thinking that it's about to take off, or they're not necessarily buying with any short-term gains in mind. People who buy in Sydney, which is obviously Australia's most expensive property market, they're buying because they fundamentally can afford to invest in Sydney. It's an expensive market to invest in. They're generally dealing with a cash flow deficit, or they're negatively geared for quite some time. So they're looking at long-term growth. Now, the longer-term thinkers, that's not really going to change. But of course, there's a lot of knee-jerking that goes on when things happen in the property market, and sentiment currently is very low. So I would say nobody's buying with any sense of optimism at the moment. And those who are, I guess, opportunistic might see some opportunities coming up that could be advantageous for them.
Okay, so you answered that question for me, which was sentiment. How is that sentiment going? And it's very low when it comes to the investors there in Sydney. Some investors are now reaching a point where holding multiple properties is becoming difficult. Strategic decisions. I want to talk about that around selling underperforming assets and restructuring debt, or in fact improving rental income, are becoming more common conversations. So if an investor, let's say for a hypothetical, owns 5 properties, 3 houses, 2 units, and suddenly comes under financial pressure, what do you think are the smartest options available in this market and in that situation?
You know, it's funny, I do personal strategy sessions often for people who find themselves in this type of scenario. And certainly if we cast our minds back to the last time we had an interest rate hike cycle, we had a lot of people that really under a lot of financial pressure. The rents weren't keeping up, and they don't keep up because the bottom line is what pushes rents up is market demand, and that's not necessarily got anything to do with inflation or interest rates. And so we saw a lot of people in this situation where they bought properties when, interest rates were lower and there was no sort of burden on cash flow. What they often think to do is look at the one that's going to ease their cash flow first, but that's really the wrong way to look at property decisions. They really do need to be looking at, well, what are the assets that they hold? It's not always the case that all units perform worse than all houses. It very much depends on what type of unit, where it's located. And again, with the houses, what type of house, where it's located. And some houses that have particularly poor yield might have fantastic capital growth because of the land value. And so you really do need to look at the individual asset and work out, well, which assets, if I hold for the long term, are going to help set me up for the wealth creation, which is the reason I bought these properties in the first place, versus which assets are actually not necessarily going to perform that well. So I like to sort of put them in 3 buckets, if you like, which is A, B, and C grade. And if I looked at all my portfolio and thought, look, I've really got 1 C grade or 2 C grades, then they're the obvious priority to look at to sell first. I want to be holding the better quality assets, not the poorer quality assets. A lot of people make these decisions based on cash flow and end up with poor quality assets, or they might sell a property that has done really well for them and might continue to do really well because they're going to realise that gain, and they keep the poor performing assets. So it really requires a very different sort of way of looking at their portfolio that a lot of people don't step back and consider.
We are talking with Veronica Morgan. More to come, including, are you waiting for the market to fall further before buying? And how dangerous, this is an interesting one, is social media, with so-called property experts informing the general public. Back after this.
Listen to expert perspectives with exclusive real estate conversations and supercharge your knowledge base with us. Don't forget to subscribe. We have so many episodes, all designed to help you better understand the constantly evolving and dynamically changing real estate property market.
Brisbane is rapidly emerging as one of the world's standout luxury property markets, driven by the lead-up to the 2032 Olympics. In fact, Knight Frank reports that Brisbane's upcoming Olympics has investor eyeballs on property big time. In particular, luxury apartment prices have surged, with top-end sales now exceeding $15 million in some developments. While Brisbane luxury prices rose 2.1% through last year, the Gold Coast climbed even higher, almost to 3%. It is a Real Estate Tuesday with Veronica Morgan here with us, and the federal budget coming up tonight as investors wait to see what property tax changes there are going to be. And there are still buyers, Veronica, waiting for the market to to decline further before making a move, what would your advice be right now to them?
Look, there's always people trying to wait to time the market, but I tell you what, even experts struggle to get that exactly right. You can feel the market moving, but you never really know whether you hit the bottom or the peak until afterwards, until the data supports that. Typically, it takes about 6 months before you get any real confirmation of that. So for someone who's not in the market day in, day out, to be able to work out when the bottom of the market is, well, that's a real challenge. And I defy anyone really to master that. So that's the first thing I say is don't try to time the market. I think you got to look for good assets, particularly if you're investing. You need to be thinking about good quality assets. And in a slower market, owners of properties that are good quality assets, you know what, unless they need to sell, discretionary sellers do not put their properties on the market during downturns. So it's actually quite difficult to find really good assets at discount prices. And what we find too is that quite often you get a really good property that comes on the market in a slow market and they'll still get competition. So anyone sort of trying to time the market and take advantage of the biggest discounts can be dangerous, because you might find yourself buying really poor quality assets and be very opportunistic and wait for one. And if one becomes available at a discount price, then fantastic, go for it.
Yeah, and finally, let's get on to something that you and I love to talk about, and that is social media, which has totally transformed the way that Australians consume property information, but it has also blurred the lines between informed analysis and personal opinion. Short-form content can oversimplify complex market conditions, and many self-described experts, inverted commas, lack real industry experience, and that's a bit of a problem. Social media has created a wave of real estate experts where opinions are often treated as facts. How careful do people, Veronica, need to be about where they get their property advice and information from these days?
But they really need to be careful, full stop, even without social media. And the problem is in the property advice world is it's completely and utterly unregulated. Property is not classified as a financial product, so it's not regulated by ASIC. A financial advisor or a mortgage broker, they have to go and get qualified, and they're also regulated nationally. There is no national oversight of property at all. So you've got buyers agents and selling agents, property managers are all licensed individually. Every state and territory has its own legislation. And then buyers agents quite often are buying across the country, many of them unlicensed. They don't even realise they need to have licenses in different jurisdictions because, again, there's no national oversight. And then you've got people who actually are property advisors who might not even hold a real estate license, because unless they're actually engaged in the activity of buying and selling, they don't need a license. And they don't actually need any qualifications whatsoever, and there's no governing body whatsoever. I'm on the board of PIPA, which is a Property Investment Professionals Association of Australia. We're self-governing, and we've actually created a course, which is the Qualified Property Investment Advisor qualification, because there's a massive absence of anything in this space that protects consumers. Forget social media, but definitely do not, your guidance from TikTok. It is full of people that really don't know what they're doing. They haven't been around long enough. They've got no evidence to support what they're proposing. And there's a lot of, as I said, unlicensed and unregulated activity going on.
Yeah, and when you look at TikTok, for an example, or even Instagram, some of these people, they've got tens of thousands of followers, and it really does make you scratch your head and say, why? All right, thanks for that, Veronica. Enjoy your Tuesday. I know that you're outside of Sydney at the moment, so thanks for jumping on the call with us. Enjoy your Tuesday. Talk again soon.
My pleasure. Thank you so much, Craig.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs, and hidden gems. We connect you to the best real estate information across Australia. The Real Estate Podcast.